It's Friday, 20th of December, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, a major EM, a spendthrift president, and a currency crisis. What next for Brazil? But first, joining me for the last time in 2024, it's Neil Shearing, Group Chief Economist. Hi there, Neil.
Hi, David. What a year it's been, eh?
What a year it's been. I hope you're feeling nice and Christmassy.
Yes, indeed. Get in there. Nearly there.
Absolutely. There's always this idea, isn't there, around this time of year that we've been the winding down period of the year, the last few days of December. But it feels like 2024 didn't get the memo. It's been a pretty busy few days looking at just the global macro picture. But one of the key events was that Fed meeting on Wednesday. The communications that came out of that really did seem to upend the market, seem to upend expectations about what's happening with policy in 2025. Talk a bit about what happened and whether this has been this sort of fundamental shift in policy that some people are saying that it has been.
I think there's several things going on. One is that I think it's pretty clear the Fed's been, I say rattled is probably a bit strong, but they've certainly been a bit unnerved, I think, about some of the strength of the recent inflation numbers. We're talking on Friday, just after the publication of the core PCE numbers. I think that will go some way to alleviating some of those concerns, so we can get into why that might be the case. But I think part of this is about progress against inflation made so far and whether they've gone far enough, and whether how far into that the last mile that we spent most of this year talking about, how far into that last mile we are. And then I think the second part to it is what's coming down the pike in terms of a second Trump administration. And in particular, to what extent are we likely to see tariffs to push up prices, domestic prices in the US over the next 12 months? And I think perhaps more importantly, additional fiscal expansion, additional deficit finance tax cuts that would lead to fiscal policy being more supportive than would otherwise be the case, and therefore monetary policy needing to be more restrictive. So there's these two concerns, I think, going on at the Fed. One is progress against inflation so far, and perhaps being a bit slower than they had hoped. And then allied to that, there's the concern about what's coming down the track under a second Trump administration. And as we've talked about on the podcast, so many of the common threads running through that agenda seem to be inflationary.
So on that basis, is it meaningful that you've got FOMC officials lowering their expectations for how much rates will come down next year based on anticipation of higher tariffs, perhaps a tougher immigration policy, but a whole host of policies, but actually we're not clear on the details, and we really won't be clear on the details until at least the sort of late January?
There's the details. There's also the timing too, right? So you might have some sense of what you think is likely to happen, but you don't know when it's going to happen is the critical part too. So I think there's a combination of details. There's a combination of timing as well. Now, given all of that, I think it's difficult to be very precise about what's likely to happen. But since the FOMC meeting, I think there's been two notable developments. The first, as I just alluded to, that PCE number that was a bit softer than was expected. Actually, it was pretty much in line with our own forecast, but a bit softer than the market was expecting. The second, I think, is the spat over the government shutdown in the US. At the time of speaking on a Friday morning, East Coast time, it looks like the government's heading into shutdown. But crucially, there's a bit of pushback to the idea from some of the kind of deficit hawks of the Republican Party as the idea of loosening rules around the debt ceiling that Trump had floated. And I think that just pushes back a little bit on the idea that Trump's going to have everything his own way and that there's going to be this large-scale fiscal expansion, tax cuts coming down the line. So I think actually if you're the Fed and you're looking at the economy now compared to 48 hours or so ago and you're thinking about inflation, then there's been better news.
Okay, better news on the inflation front, but as you say, this huge uncertainty around what President-elect Trump is actually going to do once he's back in the White House. But what about the sort of path of policy easing from here? Because Jerome Powell and others actually have talked about how the Fed is entering this phase where they're basically moving out of that restrictive stance to get inflation back under control. And they're now trying to find a level where the neutral rate of interest is. What does that process look like in practice? How do they know when they've got there? But also, is that something that other central banks like the Bank of England, like the ECB, are going to be doing in 2025, or is it too soon for that?
Yes, a critically important question was the neutral level of interest rates, but one that is inherently unanswerable, particularly in real time. So the Fed will be searching for what they think is a neutral rate. They've indicated they want to be getting back to something that they think is going to be a neutral rate over the next year or two. But they don't really know where that level is. Obviously, the Fed officials publish views about where they think the level of neutral is, but frankly, they're informed guesses rather than precise estimates. And of course, all of these things are interlinked. So to the extent to which you get additional tax cuts and discretionary fiscal stimulus under a second Trump administration, then the neutral level of interest rates in the economy will be higher. Likewise, changes to immigration policies can affect neutral rates too. So there is, in the jargon, lots of endogenous factors going on here. There's lots of moving parts and that will affect the level of neutral rate. So really, the Fed doesn't know and won't know where the neutral rate is. This has been true for decades, of course. This is not a recent phenomenon. But I think the unusual amount of uncertainty around the policy environment does mean that the neutral level is a bit more unclear at the moment. Now, for what it's worth, we think it's a bit higher than was the case before the pandemic, perhaps 50 basis points or so, maybe even 100 basis points or so higher if we get a productivity pickup based on AI. But like I say, this is really finger in the air stuff rather than precise estimates. And that goes for our estimates as much as it does for estimates by central banks.
Well, let's move away from central banks because I think one of the big questions in 2025 is going to be around, as you suggested, US trading relations. Certainly with regard to US-China, there's a lot of talk about Trump and Xi Jinping coming to some kind of agreement on trade. Some are calling it what would be a Mar-a-Lago Accord to tackle trade issue. But actually, there's also talk, isn't there, of what's being called a grand bargain, which seems to be around settling all manner of issues in the bilateral relationship, even going so far as to address the US security presence in Asia and its commitments to Taiwan. With all of this noise that's swirling around, what do you think fundamentally is the scope for any kind of agreement?
I've little doubt that there will be some form of agreement between the US and China, and indeed the US and other countries, Europe. We're talking, as I say, on Friday. Yesterday, we had that post on Truth Social from President-elect Trump suggesting that if the European Union was to purchase more US natural gas and oil, then the tariff threat against it might be dropped. So all of these constitute, I think, deals to be done. And of course, the president-elect prides himself on being a deal maker. So I've little doubt that there will be some kind of deal reached. The question, I think, is the substance around that deal. Now, some, as you say, have talked about this idea of a Mar-a-Lago Accord, modelled on the Plaza Accord of 1985, which saw this coordinated push to weaken the dollar against other major currencies. And Trump has obviously spoken in the past about a desire for a weaker dollar. However, I must say, I think not only is the economic context very different from the mid-'80s, but the political context is very different too. That Plaza Accord was reached with US allies, principally Japan, West Germany, France, UK, so G5 allies at the time. And of course, the major protagonist now is China. And the US and China are locked in this deepening geopolitical rivalry. So that makes the politics of reaching an agreement much more difficult, I think. It's going to require both the US and China to give some ground. And I don't think that either of them are particularly well placed to do that in the current context. But also the economics of this, I think, are slightly different too to the mid-'80s. The dollar's a bit overvalued when you look at the fundamentals, what's happened to the real exchange rate, but also you can justify the fact that the US should have a stronger real exchange rate by virtue of the fact that it's experienced faster productivity growth than its peers. And also it's now a net energy exporter. It's no longer a big net energy importer. Its terms of trade have improved as a result. So I think the dollar's a bit overvalued, but I don't think it's dramatically overvalued. So I think this idea that you get this grand bargain, this kind of Plaza 2.0 Accord, part of which is a coordinated push to substantially weaken the dollar, I don't really buy, if I'm being honest. I think if you believe that the dollar is going to weaken significantly over the medium term, then I would focus less on the probability of a deal with a Plaza 2.0 Accord type deal, and more the fact that America's balance of payments are quietly deteriorating again. We've had data over the past week or so showing current account deficit now 4% of GDP, the primary income balance on the current account now in deficit. I think that's a much more persuasive reason, compelling reason to think the dollar might weaken over the medium term compared to the prospect of a Plaza 2.0.
And presumably the flip side of that, looking at China's economic fundamentals, any kind of Plaza Accord 2.0 would presumably entail a much stronger renminbi, but the economic winds don't suggest that's likely.
No, actually, if you look structurally, I think you can make the case for China needing a stronger currency, right? The stronger currency would help boost Chinese consumption because it would reduce the price of imports to China. And it would, China obviously runs a large currency account surplus. That's another sign that the currency might be structurally undervalued. But of course, the economy is incredibly imbalanced too. So you would need a weaker currency to come alongside substantially looser fiscal policy, I think, to get that current account surplus down and perhaps into small deficits. Of course, that's not on the cards. Now, it's possible, indeed, it's likely, I think, that we get looser fiscal policy next year. This is something that Mark Williams, Julian Evans-Pritchard on our China team have been talking about, perhaps 1% of GDP looser next year compared to this year. That's not a major shift. It's not really going to be accompanied, in our judgment, by a raft of reforms needed to fundamentally rebalance the economy and keep it on the sustainable growth path. So if it stays on this path, then the future is, I think, loose monetary policy, low interest rates, low bond yields, weak currency. And of course, that will tend to bring it into conflict with the US.
Okay, so no big Mar-a-Lago Accord, no Trump and Xi Jinping shaking hands and smiling for the cameras, maybe. You suggested Trump's on social media saying if the Europeans buy our oil and gas, then you can take another look at these tariff threats. Surely there is, as you suggest, a deal to be done between the US and China. What would be enough to get a deal over the line, do you think?
It depends what you mean by a deal, I think, in this sense. I think this is going to be part of the challenge, I think, over the next, not just 2025, but the next 4 years, is we need to be really precise about what it is that we mean. Now, where could China give some ground and cede some ground to the US, where it could promise to increase purchases of certain US exports, agricultural products, for example? Yeah, that might help to mitigate some of the tariff threats. It might also limit the extent to which its currency, the renminbi, weakens against the dollar in response to any tariffs that are put in place. So there's lots of things it can do around the edges, but the really fundamental issues, I think, are going to be incredibly difficult to solve, partly because for economic reasons, because, as I say, I don't think the authorities in Beijing are really contemplating the types of reform needed to reinvigorate the economy, and that would obviously make the changes that the US would like to see, particularly getting the Chinese economy to be less export dependent and a bit more driven by domestic demand. That's going to make that difficult and challenging, but also the geopolitical context being very different. So China emerging as a geopolitical rival to the US, this superpower rivalry deepening. So concerns like technology transfer, intellectual property, national security, defense, those types of issues, they're just not going to go away, even if there is a ground bargain that's managed to be reached on tariffs and the currency.
It's worth adding, isn't it? I saw it to Mark Williams earlier this week, that there is a fairly mainstream line of thought in China that not only was the Plaza Accord a huge mistake on Japan's part in terms of what followed, in terms of its alleged contribution to that lost decade in the 1990s, but even that the Plaza Accord was a US trap to derail Japan's economic rise. And if you're in a policy-making establishment like in Beijing, where you see every US step as an effort to constrain your rightful place in the global economy, you're going to be looking at an approach from DC like that, to do a deal like that, with a great deal of skepticism. But at the same time, from what you're saying, it could be the question of just an agreement that if China were to buy a few $100 billion worth of US goods, perhaps looking at the phase one trade deal in Trump's first term as a model, that might be enough to get relations on an even enough keel that the tariff threat dissipates quite quickly. Is that likely?
Well, possibly. I mean, you raised an interesting point there about the experience of Plaza, the first Plaza Accord, and what others might take from that. The experience of Japan and what happens to Japan's economy following the Plaza Accord is one aspect. I think the other aspect that's perhaps less remarked upon is that as part of the accord, as part of the deal struck at the Plaza Hotel, the US was supposed to tightened fiscal policy. So that was going to play an important part in rebalancing the US economy. And frankly, the US didn't quite keep its end of the bargain in that respect either. And that gets me on to the point that you were just making about the phase one deal. China's not really kept its end of the bargain with the phase one deal either in terms of trade more recently. So I suspect there's a great deal of skepticism on both sides, both about the intentions of both parties, both in Washington and DC, but also the likelihood that they're going to stick to any promises made as part of the deal. In other words, there'll be lots of sound and fury about tariffs and trade in the next year. There's likely, I think, to be some kind of deal struck and the promises of further deals dangled. Whether that amounts to anything substantial in practice, I'm a bit skeptical.
Neil Shearing there on whether the US and China will come to terms, on a notable shift at the Fed, and on other central bank inflation and growth dynamics. On US-China, fracturing is the lens through which we've been viewing the evolution of the global economic system. And there's a whole mine of work that's been done on this topic across our coverage areas that includes interactive guides with downloadable data. I will link to our fracturing page in the podcast notes, so do check that out. On central banks, I wanted to highlight a new interactive dashboard that we've launched showing how the Bank of England's MPC members are voting and what that suggests about the bank's monetary policy path. It's called the Bank of England Caseometer, don't blame me for that name, and it's going to be really useful for investors as we move through 2025 and the MPC continues grappling with low growth and inflation, which may or may not be completely back in the bottle. Now, as of this recording, the Brazilian real seems to have stabilized after heavy central bank interventions, but the currency isn't very far off the record lows seen earlier in the week, caused by a stunning loss of investor confidence. This all flows back to that big ramp up in public spending since Lula returned to the presidency at the start of 2023. That spending has been a boon for Brazilian economic growth, but investors have lost faith and belated attempts by the government to show that it's fiscally responsible have fallen short. We held a drop-in, that's one of our short-form online briefings, earlier in the week, all about this Brazilian crisis. It was led by William Jackson from our EM team, who spoke to EM economist Jason Tuvey, and Jonas Goltermann from our markets team. And here's a clip from that briefing. It starts with Jonas talking about how far the real has shifted from what we would estimate as its fundamental value.
Yeah, I think anytime you see a sort of 10% plus drop in the space of a couple of months like we have with Brazil, at least part of that is going to be a risk premium story. And in this case, I think it's actually mostly, almost entirely risk premium driven, because if you look at Brazil's fundamentals and things like terms of trade or the current account balance and so on, they haven't changed all that much. There's been a bit of deterioration over the course of the year, but nothing that would justify the extent of the recent falls. And of course, if you look at interest rate differentials, those have moved quite sharply in favor of Brazil. So the carry associated with the real net versus the dollar is almost 10% now. That's quite a substantial cushion. That normally it would be, would lead to a stronger currency. Now, if you think about fair value, it's always a bit nebulous. But earlier in the year, when we looked at this in some detail, we put fair value for the real against the dollar in the low fives range, 5.2, 5.3, that sort of area. There has been some deterioration in the fundamentals since then. So they're probably more like 5.5, sort of mid fives range now. So with the spot exchange rate currently at 6.15 or so, that's a pretty sizable valuation gap. Although it's not as wide, it's whatever that is, 10, 15%. That's not as wide as it has been in the past crisis in Brazil. And it's not as wide as it has gotten in, if you look at a sample of other emerging market currency crises. So it's bad, but it's not as bad as it can get. And I think the other point to bear in mind is valuations are almost by nature a bit backward-looking. Markets are trying to price forward-looking risks. And in this case, the main problem, it's not that the external side is falling apart. Actually, Brazil's external fundamentals are reasonably okay. The issue is the worry about higher inflation on account of the fiscal situation, and that over time will, or quite rapidly, could erode the value of Brazilian assets and the currency. And given the fiscal outlook, the credibility associated with it has worsened quite a bit recently. I think you could justify much of this gap between our assessment of fundamental fair value and the current exchange rate. The risk premium is quite clearly warranted as things stand. This kind of valuation gap does mean you do have scope for a rebound, if credibility can be restored and action is taken on the fiscal side. But that's obviously at the moment a give.
Thanks, Jonas. I'd just add on a sort of similar point. We have our emerging market currency crisis risk indicators, and it's very notable on those. Brazil scores very low risk of crisis, reflecting that quite strong external position that you mentioned. But as you highlighted, Jonas, that these kind of measures can't take account of increases in risk premia related to political developments or changes in anticipated future inflation. It's pretty clear. You were mentioning this, Jason, that the central bank started to raise interest rates aggressively. The meeting last week was notably hawkish with that 100 basis point hike. Strong guidance about 200 basis points more hikes to come. We've seen foreign exchange intervention this week too, the central bank, really pulling out all the stops. Jonas, you've looked at a range of currencies over time, and from your experience, do you think FX intervention tends to work as the Brazilian central bank is doing, or are they fighting a losing battle here?
I think that depends a lot on how you define success. I think a lot of time FX intervention is sort of defined as black or white, it either works or it doesn't. And I think really it's more of a spectrum of outcomes. Sometimes it can work really well. If you think about, for example, during a sort of a market functioning crisis like COVID, for example, during the GFC, market functioning breaks down, central banks step in with currency intervention markets more broadly. That's a temporary liquidity problem or market functioning issue that can be addressed very quickly, and then you can get a quick rebound in currencies or wherever the central bank is intervening, because the problem isn't necessarily about the fundamentals. And the FX intervention is part of restoring confidence. At the other end of the spectrum, you have the sort of classic yen crisis, where the problem is on the external side. You have current account deficits, foreign currency debt, external debt problems, imbalances that way. And if you try to sort of address those with FX intervention, that tends not to work. The central bank just runs through its reserves and then without really achieving much. And then when they run out of reserves, will stop intervening, the currency collapses anyway. So that's the sort of, again, Brazil has probably a couple of those episodes in its economic history. A lot of countries in that part of the world does. That's also not where we are right now with Brazil. Like neither of those really apply, but more as sort of an intermediate case where, the Brazilian central bank has a lot of FX reserves. They can certainly intervene a lot more if they feel the need to. My judgment is what they're trying to do is what central banks often do in times of crisis. They're trying to buy time for a resolution on the fiscal side and credibility to be restored there. And I think if you find success is buying time, that can work. It's a question of how much time you get and what you do with it. You've seen that with a lot of other central banks in Asia, for example, have reacted to episodes of strong dollar in the past 2-3 years by intervening in the exchange rate markets, not so much to move the exchange rate, but to stop it falling as quickly as it is. The speed of sort of exchange rate falls can become a problem in itself. I think that is what the BCB is trying to accomplish, to sort of slow things down and stabilize it, to make sure that you don't get into a self-reinforcing downward cycle. And I think that's something they can avoid. I think they can probably stabilize the situation, but if you define success as turning it around and getting back to fair value, I think that probably is outside of the range of what they can hope to accomplish. And I don't think they're trying to do that either, to be fair. That's how I would see the situation. Then it's up to the politicians to, you buy time for them and hopefully they come up with a different approach. But if they don't, then currency instrument doesn't solve anything itself.
I think that's a good segue to talking about what politicians will do next. Clearly there's a lot riding on fiscal stance, looking for tightening measures. Jason, can you talk through what you think they need to do to try and calm the markets and whether we're likely to see that happen?
Yeah, sure. I think we must bear in mind that some of the measures actually outlined in the spending review a few weeks ago, the overall package was quite small, but there were actually some quite positive steps in there, such as curbing increases in the minimum wage, capping public sector wages as well. And I think for the tax exemptions that Lula pushed for, there might have been a completely different market reaction, perhaps even a positive reaction to the package. But we are where we are, and I think there's now a much higher hurdle, obviously, to surpass for the government to get investors back on side. What would that involve? Obviously, ideally, they'd patch together another raft of fiscal tightening measures that are not only larger in scale than those that have come before, but I think crucially have the clear backing of Lula. Fiscal adjustment of around 3% of GDP is probably needed to stabilise public debt. Now, we're not going to get that in 1 year, but a credible plan backed by Lula would go a long way, I think, to soothing investors if Lula could also at the same time halt his attacks on the BCB too and make clear that he will let the incoming governor Galipolo and the rest of COPOM do what is necessary to get inflation under control. Yep, that would clearly help too. And just as I mentioned a vicious cycle earlier, there's possibility of a virtuous circle. If Lula gets on board with fiscal tightening, risk premium fall back, the real appreciates, that increases the likelihood that COPOM doesn't need to deliver further interest rate hikes and may even eventually be able to turn back to monetary loosening. It's worth bearing in mind in all of this that even before they started raising rates again in September, monetary conditions were already very restrictive, and now even more so. So far as they're able to start lowering rates, that in turn helps to improve Brazil's public debt dynamics.
That was Jason Tuvey and Jonas Goltermann talking to William Jackson about why investors have thrown a strop about Brazilian economic policy and what Lula's administration needs to do to heal relations. I'll add the full recording to the podcast notes. And as I said, the FX market is looking a little calmer as of now, but there's no sign of a meaningful effort to bring public finances back under control. So this is a story that looks like it's going to develop as we move out of 2024 and into the new year. William mentioned the currency crisis component of our EM financial risk indicators. These indicators are a critical tool for understanding whether crises are likely to occur across major EMs, and it's another of our proprietary data resources that we arm clients with to navigate global macro and markets. I will link to the indicators dashboard in the podcast notes, and we'll be talking to EM economist Liam Peach, who's developed these indicators, on the weekly briefing in the new year. Speaking of the new year, this has been the last weekly briefing for 2024. Neil and the team will be back in January for what's almost guaranteed to be an extraordinary year in global macro and markets. Until then, happy Christmas, happy Hanukkah, happy holidays, happy New Year, and goodbye. Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.